Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Brian Stutland, Chief Investment Officer, Equity Armor Investments. Brian, it's great to see you as always. Welcome back to Trade Talks. And I want to talk to you about what traders are looking for in the key jobs data tomorrow morning. Before we get into that, though, let's talk about that reaction yesterday in the market with the Nasdaq 100 up nearly 5% after Powell's comments. Was that warranted?
Well, yeah, I mean, Jill, we've been talking about this now for weeks when we've had our conversations together. And what I've been saying is if the 10-year interest rate can sort of stay stable or go lower below 4%, it's going to be very good for the Nasdaq. And I think once the Nasdaq sort of burst through this 11,750 level that it had on the upside, and we got some sort of dovish, I guess traders consider dovish talk from Powell, that allowed the Nasdaq to rally, and it fed into basically my thesis is which interest rates can remain low, possibly, at least on the long end of the curve, and that will add some fuel to the fire in order to take valuations of the Nasdaq higher.
Yeah, it really was quite stunning to watch. I didn't feel like there was anything really new in the language that he had put out there. But our next key data point comes tomorrow, right? Key 8:30 a.m., the big employment data report.
Yeah, jobs number, non-farm payroll is expected to be about 200,000. We'll see if we hit that number. I think if it comes in a little softer, again, another data point that gives traders fuel to the fire to take 10-year Treasury interest rates lower, which then again will add fuel again to the fire to the Nasdaq and maybe create another rally to the upside for Nasdaq stocks and growth type names. And so that's sort of what's been driving this recent rally off of basically the midterm elections. We've had a nice rally into November, almost an early Santa Claus rally in the market. And so possibly a weak number on the jobs front tomorrow could push the Nasdaq higher. Now, we are in conditions that are very oversold in terms of volatility and positions in option trading. So to me, if I'm going to play this market to the upside, I want to own a call or at least protect the downside and own a put, own options on these levels here if I'm going to continue to play this market on the upside, because we've had a tremendous run in the market recently.
Yeah, I mean, you've been saying too, Brian, for a number of weeks now, vol is really cheap and it makes sense to buy protection now. You don't want to start buying it should we get more vol back into the market. So, you know, this is probably as low as it's been all year for the most part, right?
It isn't really at low levels here in terms of the cost to buy a put or buy a call contract. And Jill, you just mentioned, Nasdaq rally 5%. That's a huge, massive move. And I'd rather own options to participate in those massive moves rather than take the risk on the downside that I'm on the wrong end of the coin. So, to me, options are cheap. It makes great sense to add some hedging into one's portfolio, especially at these levels up here after we've had such a tremendous rally to the upside. It's a good area sort of to buy volatility, buy options at a cheap level relative to where it's been all year long, and maybe at least continue then to play the upside, but at least I have some protection on in case things go sour.
And what are your thoughts into the end of the year here? We know it's seasonally strong, and just that reaction from yesterday, it just seems as if there's a lot of demand. People are looking to buy stuff, but fundamentally, I don't feel as if the picture has changed much. I know it was strong for the consumer over the Black Friday weekend, but prices still seem really high. And I think the tell is going to be just how much this credit card debt that's being built up for the holiday season, just how well they can pay that off in January and February, because what's been propping up this market and the economy, it has been the consumer.
Well, I think you hit a couple key words here, and not a whole lot has really changed. That all of a sudden now the market deserves to have, the rally that it's seen for Treasury interest rates on the 10-year to go lower. Other than that, expectations are that all of this drive up in interest rates, even if it becomes more gradual, will sort of create this recessionary feeling, and there's this flight to quality into 10-year Treasuries. And now remember, Jill, valuations on the market have been taken down. Earnings have not been great, but they're still positive and moving to the upside. And so that has allowed the market basically on the sell-off to come down only because of valuation. So if interest rates stay low, maybe valuations can go up and the market can rally. And that's what traders are basically trading on. Not that the story has really changed. I still think there's going to be some headwinds here. And that's why I basically want to stay hedged in all of my portfolios. I want to have some sort of hedge on buy options when they're cheap now, because nothing has really changed a lot besides the 10-year interest rate being lower than it was a couple of months ago. And so for me, that still can be some concern, whether it's a recession or rates recorrect themselves back to the upside. And then now valuations have got to come down and the market has a tremendous sell-off.
Yeah, you've been consistent with that thesis, Brian. Appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.